Hi, I'm Chuck Gibson. This is Taking Stock with Art Jarvis, a bi-weekly discussion of what is happening in the economy, the world of finance, and personal investment with Art Jarvis. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Now here is Taking Stock. Art Jarvis, welcome back. I guess welcome back for me from vacation, but welcome again to another edition. Thanks for joining us for Taking Stock with Art Jarvis.
As always, love being here.
Well, as always, I appreciate that. So it's good to have you and to share your insights so that we can, in fact, take stock of what's happening in the, our economy, the world economy, the big picture and the little picture at home, too. So I know we were chatting, off air, so to speak, a little bit about, things are still going in a good direction. So what's that mean? What's happening that says things are still going in a good direction?
Yeah, I mean, if you're looking at gross domestic product, it's not only is it positive, but it's better than expected. So I think they were looking for 1 point something percent, and actually I think it came in at 2.2. So it was actually, that's true. It was almost twice as good as what they were looking for. So, and that comes when you go back to having listened to Chairman Powell talk, Fed Chairman Powell talk 15, 18 months ago. His projection was our economy was going to grow about 0.1%, and that's what got everybody concerned about a recession and things. But here we are, we're growing at 2% or more. So that's positive. Future or forecasted corporate earnings numbers continue to improve, and they're actually improving at a pretty nice clip also, so a little bit better than normal. Unemployment still looks good. Inflation, it's not down to the 2% that they keep saying they want it to be, but I think it's at 3.8 as we speak right now. So things are still looking good.
Well, the things that we feel, and one of those is like the rising interest rate, and with it not being at the 2% number that they want the inflation rate to be, are we still seeing Chairman Powell making that interest rate inch up? I've got my fingers, a fraction of an inch apart right now. But is it, how are we doing with that?
Yeah. He has at least a couple goals. Number one is get that inflation rate beat down from, we were at 9 or 10% not that long ago.
Right.
And, let's say we're at 3.8% right now. He's still trying to get down to 2%. But at the same, his other goal is not only to get the inflation beat down, but not to trash the economy at the same time. So
that's the trick.
Yeah, don't send us into a deep recession or something like that. And I'll say right now, I still don't see anything that indicates we're heading to something like that. But he's trying to negotiate a soft landing. So he's made the major increases in interest rates over the last 18 months or so, and now we're kind of in that stage where they're looking at things good and hard and potentially making tweaks. So it's maybe a quarter point, maybe it's not a quarter point, maybe it's a quarter point, and that's okay. I mean, higher interest rates does put pressure on things, and that could or could not be a problem. But if they can get inflation down, and there's a number of people out there talking now, thinking that they can negotiate that soft landing. Get the inflation number we want and not send the economy into a recession. So they seem to be more positive about that. But again, it's kind of tricky right now, I guess is the best way to put it. You're trying to meet your goal, right. But you do not and you do not want to send us into a deep recession. Will there be a recession in our economy sometime in somewhere in the future? 100% yes. We've had multiple recessions.
I don't want to hear that.
Yeah, but a recession could be, I'll say we talked about this before. A definition of a recession is 2 quarters in a row of a declining economy. So if this quarter we drop 0.1% and the next quarter we drop 0.1%, guess what? Technically we're in a recession. But is it terrible and everybody's losing their jobs and things like that? No, not necessarily. What he doesn't want to do is really stomp on the brakes and send us into something a little more deeper and a little more painful.
Well, speaking of stomping on the brakes, both you and I, over the past couple of months, have had a chance to be out there on the highway. I know, you were traveling around visiting clients and enjoying some vacation time.
Right.
And observing what's happening in the economy. And so, with that in mind, and, Sue and I just had our trip, and I was watching just because it's like I heard what you were saying. And so, like, well, what do I see? And nobody's stomping on the brakes.
No.
Nobody is stomping on, and I'm not talking about us in the cars on the highway, because unfortunately sometimes there was some brake stomping there. but that I'm talking about the spending. I mean, people are out. This summer they've been out on vacation. The restaurants are full. The
right.
attractions, as they like to call them, are active, and people are doing things. Where we were, I'm not going to tell the whole world. I don't need to do that. But it was a busy little town. It was it's a vacation touristy place, and tourists were there doing their thing. And right through Labor Day weekend, I thought, well, Labor Day weekend really look like what we remember as Labor Day weekends, and it did.
Yeah. I
mean, the town was packed, people were everywhere, and money was being spent.
Yeah.
So nobody's slamming on the brakes right now.
Yeah, and you're exactly right. I had the same experience. The highways are jam packed. The highways were jam packed with tractor trailers and trucks, which was noticeable. I mean, it was a noticeable difference than other times we traveled. But yeah, the resorts, the national parks, the restaurants, as you said, the beaches. Near as I could tell, they're rocking and rolling. There's if you go to a restaurant, you had to wait. You didn't just walk in and sit down. And again, some of these were vacation towns, but so yeah, no, that, and again, I call that kind of the Peter Lynch principle, and I've mentioned that Peter Lynch was a portfolio manager for the Fidelity Magellan Fund back in like the 80s and 90s, and a well-known guy. But he used to talk all the time that he would go sit in the malls and not only watch what stores people are going into, but watching to see if they're carrying anything out. It's
Right.
kind of that Peter Lynch principle. It's you're watching, and it's just I just don't see anything that indicates from just that whatever you call it, qualitative standpoint, but also from a quantitative standpoint, just don't see a recession in the near future.
Well, you touched on something, and I'm glad you did, because I was thinking about it while we were out and on the road, and you touched on that, the tractor trailers. And so we've been hearing and feeling the supply chain issues, and I was scratching my head, because if we're still experiencing some of the so-called supply chain issues, what the heck were all these trucks? And I mean, what's in those trailers?
Hopefully, a lot of goods.
Well, that's what I mean. That's my point, and that's why I said I'm glad you brought it up, Art, because the tractor trailers are out there. The highways and the byways have what appears to be, commerce happening. There are trucks hauling goods all across at least the eastern seaboard, up and down north and south right now. I mean, they were everywhere.
Yeah. Again, the eastern seaboard, we were out west, we were down south, we were up north. Yeah, to me, it was the same everywhere we went. But, it's the supply chain is still messed up. There's no doubt about that. It's not as bad as it was a year or so ago. It's improving, and it's going to continue to improve over time. I try to use this analogy. I'm not sure it's the best way to do it, but I view the supply chain as a nice ebb and flow, like little waves in the water. Orders come out or go out, goods come in. It's a nice, and before 2020, before the pandemic, that's pretty much what we had. It was a nice flow. But then we hit COVID, and then it was crashing waves. It's like if I could get a hold of widgets, I bought 3 times the amount of widgets I needed, because I didn't know when the next time I was going to get widgets, right?
Right.
So there's that, and the other thing is there's still that little bit of a paradigm shift. Is a lot of those trucks are Amazon trucks or Prime trucks and things like that. So you got a lot of trucks out there. The whole virtual or the online sales and purchasing and things like that.
Cyber business.
There you go. Has grown substantially. in the last few years. I mean, it happened, it was already happening, but 2020 just kicked it into high gear because you couldn't leave your house, and it's how you obtain things. So.
Well, aside from mom and pop shops, brick and mortar mom and pop shops, the cyber, overall economic picture, whether we are ordering online, whether we're purchasing online, ordering online, and having goods shipped and delivered to our doorstep, that's still, that's a zero impact on the economy in terms of loss, just because the big box stores are not seeing us walk in and walk out. Right. Peter Lynch can't sit in the mall now because that's not a fair look at what's happening, because I'm sitting at home on my computer making those purchases there. Right. He doesn't see me walk in the store and carry a package out.
Yeah, if I buy a widget, that company still has to make that widget.
Right.
So it doesn't matter how I obtain that widget.
So exactly. The GDP is not negatively impacted by a higher cyber purchase rate, or whatever.
You're exactly
digital
correct.
Cyber, whatever we want to call it.
Yep.
But
yeah, exactly. Yeah, and the interesting thing about the economic numbers that we talked about before was in my work I go based on trends. Okay, so we mentioned the labor number came out a few weeks ago, and they were looking for a 200,000 employee increase in jobs. It came out at 177,000. The market dropped like 1% that day. Well, see, I'm less concerned about what that monthly number is. I'm more concerned about what the longer-term trend is. The longer-term trend in these economic numbers is good. Okay, number one, the long-term trend is good. Number two, the government's not that good at measuring things anyway, right? So if they're at 200,000,
Art Jarvis said that, not me. But
yeah, it's true. It's like they're not gonna, and they came in at 177,000. Well, that's a near miss as far as I'm concerned. That's number two. Number three, in a normal economy, if you're cranking out 150, 200,000 new jobs a month, you're doing just fine. So why does everyone get upset and have this major reaction to a number that's only 23,000 less than what they were predicting? So I still use and that's the problem with the money. We were down 1.5% in the month of August, and now a lot of that was again Chairman Powell, and he was in Jackson Hole, Wyoming, for his big speech. Jerome Powell still, he says, hey, inflation's too high. We're going to continue to raise interest rates. And the market drops. Right. And everyone gets scared. Oh, here comes a recession. Well, and it for 18 months, this is what's been happening. Jerome Powell talks, the market drops, the market comes back. Jerome Powell talks, we drop. We have to start. If I could encourage one thing, is you have to start taking a longer term view of these things. So
you got to look out past the absolute tomorrow and ahead.
Yeah. And plus, you say, hey, we created 177,000 jobs. Well, that's great. That was yesterday.
Well, I have a question.
Okay, go ahead.
I told you that before we started, that on the aim was 200,000 new jobs, create 200,000 new jobs.
That was the consensus. Yeah.
And it came in at whoever measures and however accurately or inaccurately they do measure it, the number is being broadcast as 170 or reported as 177,000. What jobs? And why, in a world that we feel right now, there are jobs. Why are they trying to create new jobs when we know there are jobs that aren't being filled, or at least that's what it seems like? Go talk to the retail and restaurants. They can't.
Sure.
They can't fill the jobs.
Still have the same problem. Well, you got tables open. Well, I can't seat you because I don't have anybody to serve you.
Right.
I think the interesting thing there is we pumped again $6 or $7 trillion into the market during the pandemic. That money went out, and everybody got whatever amount of dollars that they received. I think part of the concern, and they keep talking about a potential recession, is that they're worried about that money that people receive during that time has begun to dry up. So one, there's a concern about the consumer spending power, because of how much money they have. But also, if I was sitting back and using that money to live my life, now all of a sudden that money has disappeared or is disappearing, then guess what? And now maybe I have to go get a job, right? So that also, maybe there's that little kind of tailwind or whatever pushing people. We need to create more jobs, and people are taking some of these jobs that are available because that free money has disappeared.
Well, so 177 is the 177,000 is the number reported. Yep. New jobs, and I'll go back and sort of, to clarify the first part of the question is, what are those jobs? And for me, I look at it as, are those sustaining jobs? Are those a job that is like a career job, a family supporting job, or are we just talking jobs? And what's that workforce? Is that workforce the part-time workers, high school kids workers, or are we talking, an actual U.S. labor force with sustainable jobs? What do you know about that?
Well, I'd say at this point, the answer to your question is yes.
If the answer is yes, these are labor force sustainable jobs that people can make a living and support a family on, then that's a good yes.
Yeah, I know there's manufacturers in town that they're having once a month they're having job fairs because they're trying to get people. Those are sustainable jobs. Those are jobs that they want you there, and they want to keep you there. And the other thing is a little bit and some of these numbers are seasonal, so there's seasonal adjustments to some of these numbers and things. So all summer kids are working, all of a sudden all these kids go back to school and they quit working, right?
That's the 23,000 that they fell short.
Yeah, that's exactly. They all came from Kings Island, so all the kids went back to school and they're not making $17 an hour anymore, slinging burgers. But you are starting to see the people go back into the fast food jobs. You're starting to see people go back into the mid-management jobs. You're starting to see people go into the production jobs and things like that. It has been, and it continues to be a slow progression. But yeah, I think the answer is still it's the whole gamut of things. But to answer your question, I think what you're asking is I take the job creation that has been going on and is going on is a positive for the economy. Right, so people are getting jobs; they're getting sustainable jobs, right? And again, the consumer is 70% of gross domestic product. So if the consumer is happy, we're happy. You start to lose the consumer, they're 70% of the impact on our economy. You start to lose the consumer, that's when you start to have a problem.
Right. Well, and the reason for the question is because the criticism, getting into the political realm of it, is from administration to administration. Oh yeah, they created jobs, but what kind of jobs were they? So that that's the foundation for that question. Sure. Is what kinds of jobs are being created, and how will they positively impact the future growth of the economy and the future health, I guess is the better word, the future health of the economy.
Sure.
And the future health of the American household or the American family or whatever that might be. Sure. However you want to describe that.
Yeah, well, I mean, if you have a job or you take a job and you're comfortable that job is going to be long term and sustainable, that makes you as a consumer, that makes you more positive, which means your consumer confidence is higher. And if you're more confident, you're more willing to make some purchases that maybe you wouldn't have made if you were less confident, right?
Absolutely.
If I need a washer and dryer, if I'm confident, I'll go buy that washer and dryer. If I'm not confident, maybe I'll continue to go to the laundromat, right? So it's the way. And again, that's the thing. We've talked about this before. I wish they spent more time on like behavioral finance and things like that in college, because truly, it's a numbers game. But so much of it has to do with investor and consumer psychology and things like that, and how do you feel and things like that. And I can tell you this is where we should be in the stock market. But guess what? How many times have we been 1 to 3 standard deviations above or below where you would think we should
Right.
be. And that's because of fear and greed. If I'm scared, I'm not spending money, and I'm selling my investments and all those things. If I'm greedy, now all of a sudden I'm getting in, and it's like I'm going to make those purchases. I'm going to start buying stocks after we've already gone up 40% or something like that. And but long answer. I think that what we're seeing from a job creation standpoint is a positive.
That's good.
Yeah, how's that for a long-winded answer?
Perfect. Well, we had a few seconds to eat up.
Did we? Okay, good. Glad to hear that.
But
Yeah.
you know what? On the note, though, and we did this on the last episode, we talked a little bit about, you touched on the behavioral finance.
Right.
And so I think it's great that you touched on it again. And I kind of like to keep going that way on our next Taking Stock.
Yeah, I'd love to.
But before we just wrap up today's edition of Taking Stock with Art Jarvis, what's your highlight for what's happening right now? What would you like? Get your little yellow highlighter pen and mark that this is what's going on, and pay attention to it. What's that?
I think what gives me hope is I think we have seen here, especially in 2023, we have seen a shift from all that negativity we had in 2022, where the market dropped 20%. We have seen a shift in the psychology of the investor and the psychology of the consumer, things like that. That all that negativity that we were hearing, and it was a foregone conclusion we were going to go into a recession in 2023, 2024, right, or even in the end of 2022.
Yeah, well, that's what.
Guess what?
Yeah.
We're growing 2% a year, so we're not even close to a recession. So I think not only have people come to the realization that the economic numbers are not fitting the rhetoric that's going on, but you're actually starting to hear our leaders and the people in the Fed and the Fed governors talk about that, hey, maybe we can actually negotiate a soft landing without going into a recession and take care of it. So for me, I think that if I had to pinpoint something that's going on today, that would be probably the thing. And I think that's important because if you have that positivity and that change of attitude, that's going to keep the economy propped up longer.
Yeah. Well, before the, I won't let you use the generalization.
Okay.
Because my next question is about the investor.
Uh-huh.
And, we're talking to investors and taking stock. And, what's your advice to the investor? And that's where I said, I'm not going to let you use that generalization.
All right.
Buy low and sell high or whatever. But if, at the end of today's edition of Taking Stock, what's a morsel you would throw out there for investors right now? Because I think I'm going to call it a bullet point on your highlight right now is the economy's growing.
Mm-hmm.
So in a growing economy, what's that one tip you would give to an investor?
I think I've said this a couple times. It's stick with the plan.
That's a generalization. I'm not letting you get away with.
When I sit down with a client, we talk about time frames, we talk about liquidity needs, we talk about risk tolerances. Okay, so if I'm sitting here and their time frame has not changed, their liquidity needs have not changed, their risk tolerances haven't changed. Well, there's nothing going on in the economy that should cause you to want to make a change. Is there going to be, depending on where you are on that risk curve, is there going to be, some places there's going to be less volatility, some places there's going to be longer term or greater volatility. But, if you're that 25-year-old, take the volatility because you're going to be way better off in 30 years. If they're that person that's about to retire, then you want your volatility to be less. So you started, and the nice thing now, we've talked about it again, is we don't have 0.5% interest rates. Now we got 5.5% interest rates. So you can get more conservative in your portfolio, but yet still make a decent return. Right. So am I still generalizing? Or
that was good. No, in all honesty, and not to pat you on the back or patronize you since it's your show. No, I think those details about what is a generalization is important for people to know. You're not just saying, "Hey, stick with the plan." It's like there's a reason for you to stick with the plan, and unless you are specifically seeing some changes in your own personal world that like you said, your tolerance and your whatever. I can't think of all the different things, but if
Time
there's 3 or 4
frames,
different
liquidity.
things,
Yeah.
liquidity.
Yeah.
Your need for liquidity or your risk tolerance has changed. Then sit down with your expert, or get a hold of Art Jarvis if he needs to be your expert.
Yeah.
But other than that, that's what it's about, is taking stock. And right now, taking stock of the situation, the marketplace is still a good place, and you should stick with your plan, is what Art Jarvis is telling us.
100%. And don't get me wrong, there are times where it's time to make some adjustments.
Right.
2008, the Great Recession, the financial crisis is a perfect example. We were doing things in our economy and in our marketplace that we should not have been doing. Right. And it's kind of interesting to me that we've already kind of started moving back to doing some of those things, right? We have very short-term memories, behavioral finance. But there are times when things get completely out of whack and you need to make adjustments, okay? It's just wearing in your face. It's like, this isn't right. It has to adjust one way or the other. But the vast majority of the time, you come up with a plan and you stick with that plan. Now, there might be little tiny tweaks in there. I have clients that I've had for 30 years. There have always been little tiny tweaks in there. But you stick with the plan. You don't panic. You don't get greedy. You end up doing pretty well.
Perfect.
Yeah.
Well, Art Jarvis, thank you again for being with us for another edition of Taking Stock, and we look forward to the next one, hopefully 2 weeks
Sounds
from
good.
today.
My pleasure. Always enjoy it.
Take care, Art.
All right. Thanks, Chuck.
Thanks for joining us for this edition of Taking Stock with Art Jarvis. Join us again in 2 weeks for our next edition. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Jarvis Global Investments, LLC is a registered investment advisory firm. The advisor is not attempting to furnish personalized investment advice or services during this production. Individuals should fully investigate the appropriateness of any investment before investing. Past performance is no guarantee of future results. Investments may lose value.